I
How are
love
you?
the hairband music. It's kind of,
Well, it was lack of, not intentional, it was lack of creativity this morning to find a different song. So
I love it. No,
we'll
it's
leave it there.
nostalgia. It's
Um,
nostalgia. We love it.
all right. So is today a holiday?
Technically, tomorrow
Yeah,
is obviously Veterans Day, which we honor our vets that are here. We have a lot of amazing vets a part of our organization, so we love them.
absolutely. I think they deserve every bit of honor and then some. So
Probably every day. Probably every
yes,
day.
there you go. All right. So a couple of interesting things, Kelly, before we dive in. I got the opportunity to attend the Zillow conference last week, and last week I think we talked about, or certainly at our State of the Industry presentation, we talked about NAR is predicting an increase of 14% of existing home sales next year. And they're predicting a 3% increase in new construction sales next year. So I felt, okay, that's pretty optimistic, right? Like that's a big jump. Hey, Rick, how are you? Let me spotlight you here.
I'm
Um,
good. Sorry,
so
got
the
delayed.
uh, the NAR has a very optimistic view about 2026, and then the Zillow. And one of the reasons I like, why am I echoing? One of the reasons I like going to the Zillow conference is it's a tech company's perspective on our industry versus a brokerage company's perspective on our industry. And I like to kind of get the different perspectives. And the economist for Zillow is predicting 3.5% increase in home sales next year, which to me is a very drastic different than NAR's number. However, um, I believe we will sell more houses in 2026 than we did in 2025. And I think that's a very positive thing. And one of the things in business we operate around is nothing's for certain, right, Rick? Like we've how many things have we thought were true and then something happens, and but we operate around probability. And the probability says we will sell more houses next year. And I think you should hear that. And I think you should plan for that. And you should push for that in 2026. What do you think?
You know what I do believe? Obviously, there's statistics on how many more homes we think we'll sell, and we'll end up seeing if these predictions are true. But I 100% believe that if an agent in their heart believes they'll sell more homes and puts the activities, they will sell more homes. And the market, I do believe, to ask you to go back to your question, I think we continue on interest rates coming down. We will have more sales in 2026. We have everyone I speak to mentions that they have people they're already talking to about 2026. And as we all should, this is the month you should talk about 2026 with database. So I agree. I think we'll have more sales, but wholeheartedly, you as an individual will have more sales if you have the mindset that you can get more sales, and obviously put in the activities for it. If you think it's going to be a bad year, guess what? It will be a bad year for you. But if you think it's going to be a great year for you, you can make that happen.
And
Create your own reality, right? Go ahead,
yeah,
Rick.
my recommendation is ponder the size of your market area and recognize the difference between an average and a great year is probably one extra transaction a month. My guess is there's 20, 30, 50, 100,000 people that are inside of a geography that you could target and win business with and help them buy or sell real estate. I mean, it's a numbers game and play to win because I also believe to some degree there are no good or bad markets, just markets, and you've got to find the opportunity and then snipe instead of shotgun.
Yeah, for sure. I mean, we've talked about this forever, like create your own reality. The market's going to give us what the market gives us. Yet we have agents in Atlanta that grew their business 20% last
Mhm.
year. And if you just looked at the market would have said not possible.
You
But
you know it's amazing, Brett. I love this. I have an agent here, and he may even be on this call. 3 years, just over 3 years in the business, this year is his best year in the business because he just stayed steady, consistent, and didn't buy into that this is a tough market. He just kept doing his activities. And then I have other agents who's lived through the hard times, and then they come out going, you know what, I can still make this a great year. And so I 100% agree. It is what you think about and what you do.
Yep. So a couple other quick comments. The economist at the Zillow conference also made a comment that I don't think was very popular in the room, but he said he's predicting that mortgage rates will stay above 6% in 2026. Now, I started thinking about that, and I think there will be, when he says that, he's probably saying the rate for the whole year 2026 will average above 6%. I think there will be moments where we get below 6%. But I also think the other statement in that is if anybody at this point in time is sitting around waiting on making a buy decision, waiting on a rate to come down, it's just not a reality, right? Like, and how do we dispel that as agents as your best time to buy is now? Like, the pricings are not going to get any better. Your competitive advantage at the negotiating table is not going to get any better, and the rates are not going to drastically change to where it's going to make any bit of difference for you to wait.
Well, and the conversation has to be about quality of life and long game. How long do you plan to live there? One of the articles that I think is coming up today speaks to the reality that homeowners today are thinking 15-year terms inside of
Mm-hmm.
a home. So if you're on a 15-year cycle, there's no time like now to start the journey of homeownership.
100%. Well, let's just jump in. All right, Fulton County.
And we're speaking to
Active.
the converted. Everyone know we realize this is layered information, not newfound.
Oh, 100%, right?
And it's about
Um,
application.
so Fulton County, end of September was putting 1,100 active status change listings, came down under 1,000, and then the last 2 weeks has been under 800. So you might think that looks negative. I actually think that's positive
Mm-hmm.
because it's pulling the inventory down. It's helping right set the balance between supply and demand, and it's still a healthy number of new listings going on the market right now. It's just not the same level at which we were experiencing there in the months of September. More importantly, 129 went active under contract. We had 140 the week before. So perspective, before the last 2 weeks, it was 108, 112. There was a 120, 107. And there were a couple of weeks back here, there were 77, 98, or 96. So 129 is a very
Mm-hmm.
healthy number. Ironically, in the middle of November, when the weather is cold, I'm kidding, it wasn't cold when they went under contract. Um, but that's really positive for Fulton County.
Yeah.
Um, 296 pending is like music to my ears. Look at these numbers before. 59, 251, 261, 230. Now we're at 296 pending going into the last 2 months of the year. Uh, you know, the other comment the guy at the Zillow conference made, he said, I stood on stage at the end of 2024 and said, wow, what a wild and crazy year. 2025 is going to be better. And he said, now I'm standing on the stage going, wow, what a wild and crazy year. 2026 is going to be better. What am I going to say next year? And I was like, but if you just look at the stats that we track on a weekly basis, what a wild and crazy year this has been. It's all over the place. And to be 296 properties pending on the 10th of November in Fulton County, you definitely could say wild and crazy, but I'll take the good crazy right now.
I personally love seeing this pending number because it says we are keeping contracts together. And that has been the struggle all year long as people, just the fickle buyers out there that are pulling out of contracts or agents maybe need to brush up on those skills of keeping contracts together. I love that I am seeing it higher, which means we're keeping it together. And I love, to your point, Brett, the inventory, the active's not coming on the market. You really have another 2 weeks. Not to say you can't get 3 or 4 more weeks, but really the next 2 weeks, if you want to close before the end of the year, your house needs to be in the market in the next 2 weeks at the latest. That gets you in before Thanksgiving weekend, and then that gives them 30 days to close out from a lending perspective. So I love that maybe some of our used or existing inventory will start to be used in addition to not having as many pop on. So I'm loving this month of November sign so far.
And you can see it in the closings in the last 2 weeks. We had some low weeks leading up, but now we're over 300 for the last 2 weeks in a row in Fulton County in closings. Good sign. Let's move a little faster here. So 430 in the DeKalb County, active status, same kind of story. It's gotten a little lower, but that's a good thing. They had 65, which is kind of a flat number for DeKalb County. It's not good or bad, but they had 80 the week before go under contract. But they're at 163 in pending. That is, we had a 183 back in early October. So maybe similar numbers for October in DeKalb County. 168 closed out in the last 7 days, 185 the week before. You could just see this lull in the market in the month of October. And my optimism hopes that November and December are going to be good months. And I'm seeing it in the numbers. We just got to close all the contracts, right? For Cobb County, 389. Certainly the inventory, active inventory has come down a little bit. Same comment, that's a good thing. 91 active under contract. There were quite a few weeks in September that were in the 70s. And then we got back over 100, and we've been right around 90 cents in Cobb County. So it's still more than what was before, which is positive. And then 186 pending is the highest I'm seeing on here since August. And even most of August wasn't that high. So these are just really positive numbers, guys, of what's coming forward. And then you look down here at 189 closed this week, 169 the week before. Perspective, it's pretty equal, but there was obviously a low week 3 weeks ago. So any last thoughts on the numbers before we move on?
Yeah, don't let seasonality be your excuse. The numbers are pretty steady, Freddie. If you're not getting your unfair share, rethink how you're attacking lead generation.
All right. Are we going to have a government this week, guys?
Be nice if we did.
Apparently, this hit the news article this morning that there's some deals supposedly struck, and maybe the government will open back up. Here's the thing, void of any political comments, the strategy around this is, and this is personal opinion, what I believe, no matter what side of the fence somebody's on, there's a certain level of consumer confidence and there's a certain level of anxiety that gets affected by the mass amount of media coverage of things. And I don't know that it's 100% translated to consumer confidence, but I got to believe that some of it did. And if the government reopens, I think it eases anxiety, moves us forward at a faster pace. And I think that would be a really, really positive thing. Y'all agree, disagree?
I think everyone agrees.
Yeah. Mm-hmm. All right. Real quick, there is a NAR 2025 profile of home buyers, sellers. This is a giant document, guys. I'm not going to pull it up on this call. However, here's what I think we should say about it. This gives you profile of what the buyer and seller and how they think and how they find their agents, what they put priority on. And if you're a professional in the real estate space, you deserve it. You deserve to yourself, or you owe it to yourself to read through this report. More importantly, you should read through this report to create the strategy of how you communicate and how you present and what you do from lead generation standpoint going forward, because this is the most relevant intel behind you doing business planning. It's such a powerful tool that only comes out once a year and it just got published. So I'd really encourage anybody to dive into it deep.
Luke put that in the chat. The link's easy to grab. So do
Yeah,
that
we
now.
post all of it in Circle, but if you're on the call, there you go. The other thing I would say, I'm hitting a couple quick articles so we can get to some of these others, but the um, the U.S. economic climate. One of the things that's happening on a scale at the U.S. level is unemployment is rising. And why that's important to us to understand is that is a factor that plays into the Federal Reserve and their motivation to want to lower the Fed rate. However, it doesn't translate hyper-local sometimes. So I'm going to click this article and I'm going to show you. They're talking about unemployment insurance claims the week of October 18th. And you get down here to this chart, which is wild to me. The initial claims, Kentucky went up 166%. And you will notice Georgia is not even on the top 10 list. And then you get down to continued claims, and Tennessee's like 30% of it. And Georgia's not even on the top 10 list. So I'm going to go out on a limb and say, while the global economic environment is having increasing unemployment, it doesn't specifically translate to our market, yet the global version of it translates to the Fed's policy. Does that make sense?
Mm-hmm.
So somebody tell me why Kentucky's up 166%.
Well, if you don't see the raw number, you don't know. There's no relative sense. So is it 500 to 800 or 900, or is it 50,000 to 100,000? I mean, 166% is like two people to 3.5. It's hard to know without a raw number. That's all.
With the population, yeah.
The good news is
I
we're
thought you were going
probably
to make
not.
a joke about the bourbon industry, but or the horse racing industry or something. But uh, I do think Tennessee leaks into Georgia. So if people are having trouble finding employment in Tennessee, some of those people move down to Atlanta.
That's a good point. Proximity.
Yeah. Anyway, all right. Last quick, and then we'll get into more dialogue. So there's an article here called, it says Realtor.com is gaining on competing portals despite decline in users, owners say. So here's all I wanted to say on this is, in real estate, one of our goals on this call with Rick Kelly or any of the team leaders that are on this call is to bring information to you to help you see the forest through the trees, right? And there's so many aggregators in our industry, from homes.com to Zillow to realtor.com, and those are kind of the big three, right? Yet I actually think realtor.com, if I'm putting my head around this, Microsoft was the company in the country for a long time until Apple became sexy. But did Microsoft go away? No. Is Microsoft still a great company? Yes. Realtor.com was the company until Zillow became sexy. So in my analogy, Realtor.com is the Microsoft and Zillow is the Apple, but that doesn't mean there's not an opportunity for leads through Realtor.com. I do think you got to do your due diligence. I do think you have to hold your money accountable and all that stuff. But it was just kind of a weird reminder to me when I saw this that, hey, Realtor.com's still a player. What do you think?
I think when I read through this, I love the idea that it's still a player. I agree with that statement. And I love their analysis. They said, while there may be fewer unique users are staying on the portal longer. And I kind of look at what are leading indicators of where the market's going. And like we would say open houses, for example, if you're getting robust turnout, or light turnout and you consistently do open houses, that can kind of tell you, are you expecting more buyers coming in or not, or potential sellers? And when I saw that they like to stay on there, I go, that's very indicative of this market right now. People are researching a lot more, thinking a lot more, they're sitting on there. So these are going to be, it tells me that the pool of whether it's buyers or sellers are going to continue to be more informed. And so when we go in front of them, we need to know that they are equally staring at the market as much as we are, but we have better data and we have these conversations weekly. And to me, I love knowing that there's more than one or two portals that are out there winning and playing. But I love the data of going how they can tell us how each user is using the data that they provide. So I would say we're going to have very informed buyers and sellers in the next year if they're staying on the site long. And then I think it also means that these are going to be very thoughtful people that we're going to encounter if they're all sitting on sites for a long period of time.
Yep. And it matters if it's a collective decline in interest or is it just isolated to their marketing efforts and ability to target and draw eyeballs.
Yep. I mean, not every agent plays this game, right? And you don't have to play this game to win. But if you do choose to play this game, you should play it well informed, right? And this is just a good article around being well informed. All right, there's this is a quick FYI. This article came out 4 days ago on Housing Wire that they're continuing to talk about this Vantage score. And Vantage score is the competing product to FICO score. And it seems to be the government is very motivated to get lenders to adopt using Vantage score, either in replacement of FICO or. And I just want you to know what the heck Vantage score is. So if your buyer makes mention of Vantage score, your brain should just go to, oh, okay, that's the that's the same thing as your FICO score. That's all you really need to know. I don't think you need to know the ins and outs of why and this, that, and the other. The motivation is really around affordability. They think FICO's monopolistic, and they want to bring the cost down to the average buyer buying a home. It's really the motivation behind it. But if you hear Vantage score, that's what it is. All right, Rick Kelly. This is one of those moments. 2 years ago, I started predicting I think we're going to see 40-year mortgages. And I don't know why I started predicting that outside of affordability was like the big topic at the time. And I thought, oh, well, they probably should do longer mortgages to bring the cost down. Like car loans went from, they used to only be able to do 3-year car loan, and then you got a 5-year car loan. Now I think you can do like 7-year car loans. Well, this week, Trump proposed a 50-year mortgage to help with affordability. So I was saying 40, he said 50. However, I want to facilitate a conversation around what this really means. So on the surface, if you might think buying a house with a 30-year mortgage versus buying a house with a 50-year mortgage would be way cheaper. However, I'm going to show you a graphic real quick. And then Rick, give me your thoughts on it. It's not that much cheaper.
That was my aha. I was like, I thought it would be dramatic, extending
Yep.
20, but what it tells me is you're not paying down the mortgage. It's still front loaded interest. And clearly the net, it's a good narrative and it's a good conversation starter and it's a good consulting opportunity for someone to depict, what's the best path relative to affordability, your comfort level, and then how fast do you want to build equity? I don't know that, I pay an extra payment every once a year in December so that I can reduce my mortgage time from 30 to 24 and a half or 25, I believe it is. There's a number. And that's just me enjoying watching my debt go down and my equity hopefully go up thanks to appreciation. The risk is on a 50 years, you're really hanging your hat on appreciation for the true value other than quality of life reasons when you buy a home.
Yeah.
Because you're not paying it down. It's not a form of forced savings to the extent it could be if you took a shorter term.
Yeah. And, I think most people, when they hear this story, think this conversation was motivated by affordability and reducing cost, right? However, when I was having this conversation earlier today, there was a different perspective brought to the table that I hadn't thought of prior to, which is why I love having conversations like this. Is this this could extend somebody's buying power. So, for instance, if they were qualified for a $450,000 home, but they couldn't find anything at 450, it could extend them to 550 to get the home that they wanted with a 50-year mortgage on that property versus a 30-year mortgage on a $450,000 property. So in one regard, it could be a buying power conversation. On another regard, it could be a cost savings conversation. I think it's variable, right? Like it depends on the circumstance, but um, it's going to be a hot topic, whether it's the right thing or not. Um, Kelly, are people talking about it, or is this just new? Or
No, but there was I think a year ago, at least I think of one mortgage company that offered 40-year mortgage terms. So I think if you're going back to the NAR stat that people are now staying in your home 15 years, if you're ever going to do a lengthy mortgage like a 50-year, you better be that 15-year person and then become disciplined in the way you spend your money, because it could give you that, to your point, that buying power, that 500, 550 house if you're would be 450 otherwise. But if you're in it 15 years, that's great. But if you're a short-term person, that's not the right mortgage for you. And that's why you want great mortgage professionals to do it, because I do think we can't fully always rely on appreciation, especially if it's in the next few years. I think at your Zillow, they all estimate like moderate appreciation come 2026. So that's where, I think it's a professional decision with a professional. What's the right mortgage for you?
yeah, I mean, if you're a 50-something-year-old home buyer, you're not buying a house with a 50-year mortgage with the expectation you're going to outlive it. Now, if I'm 20 or I'm 25-year-old first-time home buyer, I may not care. I'm just happy to get a house, right? And you're going to bank on the appreciation over time. But if you stay in a house for 15 years, you're going to get your appreciation, period, right? And maybe you don't care, but uh, I don't know. It's very interesting.
But you control the outcome still with the way you treat money, and you can, again, put money towards principal in most loan types, and you can offset that if you chose to when the timing's right. If you knew you had a circumstantial need to qualify using a higher term or longer term mortgage, I see it as a strategic option and a conversation starter. And then again, our jobs as professionals to align with other professionals in that arena and then help them make qualified, intelligent decisions based on fact.
There you go. I mean, that's the professional real estate consultant, right?
That's it. And this is a piece of it, being a soundboard and, being able to help them process information.
Well, and what I love about these calls is we process it first because it's new information to us, right? And we got to think through it. All right, I'll end on this article. The homeowner equity boom is over, but a troubling metric is inching up. Clickbait. So is the homeowner
100%.
equity boom over? No. Maybe the boom is over, but there's still going to be equity creation in real estate. It's just not going to be at the same level that it was over the last 5 years. It's probably going to go back to normal. which is around 4% a year. The other thing on here it talks about is seriously underwater mortgages increased to 2.8%. Rick, I'm going to give you this one since you're the REO guy. How should we be thinking about this?
I think it's still in a normal range historically and not to be panicked around. It's just something to watch. It's a trend. It's going up. It was 1% forever and a day, it feels like. I just, that's not a catastrophic number back in the day. In fact, I researched 2009, 25% of all homes were underwater and their loan balances were below the value, market value. So it's, I wouldn't say insignificant, but certainly not significant.
Well, I
And the other
think
piece of it is they talk about homeowners decreased to 46%. The equity rich piece is, is your loan to balance 50% or lower? In other words, if you own a $300,000 loan, a house, is your loan 150,000 or less, depicting equity? And so it's a little bit of again, clickbait, skewed data, but there's enough content here that it's a fun conversation and a possible, a publicity moment, to be able to publish. Hey, if you saw this, call me.
Yeah, that's the whole social media game, right?
That's it.
How do you take it and make it a talking point to attract leads?
Most of our market areas have appreciated 6, 7, 8, 10%, 12%, even more annually for many years back to back to back to give back. I think Georgia's number was about a 5% decrease. It's not overall, but that's in the collective sense of what they call equity rich.
Yeah.
And I think the number was like 46 point something to 41 point something. And I was like,
Right.
my goodness, we're over 40? That's amazing.
That is amazing. How do you
Last
spin
thing,
incredible news and make it bad? They did it. Good job.
There you
Correct.
go. You can read this article later. Just FYI, this is talking about a community in Marietta where a builder, Traton Homes, is plotting another project, about 80 single detached family homes in a mini center. If that's your market, you should certainly be aware of it. All right, guys, happy Monday. And once again, if you weren't on the call at the very beginning and you're a veteran, we celebrate you. Thank you for your service. Tomorrow's your day. Appreciate and love all of you.
Take care, peeps.
Bye.
Love you. Bye.
Bye, guys.